Welcome back to the Explainer. So if you've always thought dividends were just a boring secondary perk for retirees, well, prepare to have your entire perspective shifted today. We are taking the data from heavy hitters like Hartford Funds, Wellington Management, Ned Davis Research, Fidelity, and 24/7 Wall Street, and we're turning it into a dynamic wealth-building masterclass. Let's get right into it.
All right, we have to kick things off with a number that literally rewrites the rulebook on market returns. 85%. According to data from Hartford Funds, since 1960, a massive 85% of the S&P 500's cumulative total return is attributed entirely to reinvested dividends and the magic of compounding. Think about that for a second. The financial media is always obsessing over daily price swings, but the actual silent engine of wealth creation over the last 6 decades, it's the dividend. To really put that into perspective, let's look at a $10,000 investment in the S&P 500 back in 1960. If you just relied on the stock price going up, you'd be sitting on about $1.14 million by 2025, which, is not bad at all. But if you had reinvested those dividends along the way, that exact same 10 grand would have skyrocketed to over $7.58 million. The math is just undeniable here. Dividends aren't some tiny add-on, they are the absolute heavy lifters of long-term compounding. Here is our roadmap for today. We're covering 1. The hidden power of dividends. 2. The high-yield trap. 3. Navigating dividend taxes. 4. Dividend growers and initiators. And 5. Top dividend ETF strategies. Section 1. The hidden power of dividends beyond the price tag. Look, dividends aren't exactly the flashiest part of your investments. They for sure don't get the hype of the latest tech IPO. But here's the thing. Corporate cash levels are historically high right now, making dividend-paying stocks incredibly relevant. These companies are sitting on massive cash reserves, which means the healthy ones have the actual capital to maintain or even grow their payouts. So you get a tangible, real-world return, even when the broader market is getting totally chopped up by volatility.
Section 2. The high-yield trap. Why more isn't always better. Now, the natural instinct for anyone new to this is to just scan the market, find the absolute highest yield, and click buy, right? Actually, scratch that. It's a massive trap. A fascinating study by Wellington Management looked at 9 decades of data, splitting dividend payers into 5 tiers or quintiles. And guess what? The absolute highest yielders, that top tier, were not the long-term winners. It was actually the second quintile that outperformed the highest yielders in 6 out of 10 decades. So chasing that top-tier yield is basically a losing game. But why does that happen? The secret sauce here is the payout ratio. That's the percentage of a company's earnings paid out as dividends. The Wellington study found that those highest yielders were bleeding cash, averaging an unsustainable 72% payout ratio. They were practically shoveling all their profits out the door just to maintain the dividend, leaving literally nothing for business growth. Meanwhile, the second-tier stocks had a much safer 49% average payout ratio. They gave you a great yield, but importantly, they kept half their earnings to reinvest in themselves. Basically, an outsized yield is often a giant flashing warning sign. The market prices the stock lower because it senses trouble. And if a company with a 72% payout ratio hits even a minor speed bump and is forced to cut that dividend, well, it usually drags the share price down a cliff with it. You end up losing your income stream and your capital at the exact same time. Section 3. Navigating dividend taxes, keeping what you earn. Okay, so you found a sustainable dividend. Awesome. But your next major hurdle is the IRS. How you hold these stocks completely dictates how they're taxed. Fidelity points out 2 main buckets, qualified and non-qualified. To get this sweet, lower tax rate, your dividend has to be qualified. And to pull that off, you have to follow a very specific holding rule. You must hold the stock unhedged for more than 60 days within a 12 one-day window that starts 60 days before the ex-dividend date. Basically, the IRS wants to reward actual long-term investors, not day traders just trying to scoop up a quick payout. And this is where the rubber meets the road on your tax bill. The contrast is wild. If you don't meet that holding period, you're stuck with non-qualified dividends. Those are taxed as ordinary income, which could hit you with rates as high as 37% depending on your tax bracket. Yikes. But if you follow the rules and get qualified dividends, your tax rate is capped at the long-term capital gains rates of 0, 15, or a maximum of 20%. That difference right there, that can literally make or break a retirement plan. Section 4. Dividend growers and initiators, the sweet spot. So, to piece this puzzle together, getting steady income, dodging those value traps, and keeping the IRS happy, what exactly should we be buying? Check out this data from Ned Davis Research. Over the long term, companies that either grew or initiated their dividends delivered an average annual return of over 10%, with a volatility of about 16%. On the flip side, companies that cut their dividends, they had negative returns and massive volatility, almost 25%. So the takeaway is clear. You don't just want a dividend, you want a dividend that is actively growing.
Section 5, Top Dividend ETF Strategies. Your action plan.
So how do we actually put all this institutional research to work without driving ourselves crazy analyzing hundreds of balance sheets? We look at 3 specific ETF strategies outlined by 24/7 Wall Street. Enter the big 3: SCHD, DGRO, and VYM. Now, these are definitely not interchangeable. They each play a very distinct role depending on if you need immediate yield, inflation protection, or just incredibly broad diversification.
First up is SCHD, the Schwab US Dividend Equity ETF. Think of this as your core anchor. It holds about 100 stocks, yields around 3.9%, and costs practically nothing with a 0.06% expense ratio. The brilliance of SCHD is in its methodology. It actively screens for cash flow to debt, return on equity, and 5-year dividend growth, so it automatically filters out those dangerous value traps we talked about earlier. It's solid enough to safely fund a 4% retirement withdrawal rate. Next, we have DGRO, the iShares Core Dividend Growth ETF. For younger retirees or anyone stressed about inflation, this is your growth engine. DGRO strictly requires its holdings to have consecutive years of dividend increases. Because it focuses so hard on those growers from the Ned Davis study, the current yield is lower, around 2.2%. But the total return is just phenomenal. We're talking 248% over the last decade. It leans heavily into companies raising their payouts faster than inflation.
And finally, VYM, the Vanguard High Dividend Yield ETF. If you lose sleep over concentration risk, meaning you hate having too much money tied up in a few top stocks like SCHD does, VYM is your best friend. It holds a massive basket of roughly 440 stocks. Sure, it doesn't have the ultra-strict quality screens of SCHD, but its sheer size completely dilutes the impact if any single company cuts its dividend. It's basically the ultimate safety net.
The best part? You don't have to pick just one. Blending these creates a beautiful barbell strategy. You get high-quality current yield on one side with SCHD, long-term payout growth on the other with DGRO, and massive sleep-well-at-night breadth in the middle with VYM. It's a structural approach that ensures you get paid today, get raises tomorrow, and don't panic when the market decides to get bumpy. So, I want to leave you with a question to ask yourself. Is your portfolio built to strategically pay you a growing stream of qualified cash, or is it just built to fluctuate wildly with the daily news cycle? Once you understand the mechanics of payout ratios, the tax laws, and how to utilize the right ETFs, you gain incredible leverage. I hope this explainer helps you take absolute control of your financial future and build a true income stream that lasts. Catch you next time.